unfortunately for people investing, crypto just became the easiest source of liquidity, right? It's just sitting there. It can be easily sort of liquidated and in order to capture more liquidity. And so when I look at it as anytime you have global dollar liquidity running below nominal growth, you have to source it. Either the growth has to come down to meet the liquidity, or you've got to liquidate something in order to fund the activity. Germany shut down many of its nukes, became incredibly dependent on Russian gas, and then has now had a huge deindustrialization problem.
The fourth turning may be one of the most important economic and investment themes of our generation. What is it? How will it impact our lives? How is this fourth turning going to change our civilization over the next 10 years, and how do investors position for this revolution? We'll talk about this theme with our next guest, R. Patrick Kent. He is the portfolio manager of Hedgeye Asset Management. Welcome to the show. Patrick, good to see you.
Yeah. Hi, good to see you. Thanks for taking the time.
I've had Neil Howe on the show before, so he's the author of The Fourth Turning. People could check out our interview with Neil before. I've had Keith McCullough on the show, CEO of Hedgeye. People could check out our Keith interview down below. And you're new on the program, but Hedgeye is no stranger to the program. People love Hedgeye. People love the work you guys are doing, so welcome to the show. Let's start by talking about your current positioning rather than, and then we'll transition into what the next 10 years is going to look like. I want to just paint a picture for the audience, how our world will be different in 10 years and how our portfolios need to be different to match that change. But first, let's talk about tactical positioning in the next 6 to 12 months, because you are also involved with long-short positioning as well. So talk about, tell us about sentiment right now in the marketplace. There seems to be a lot of fear, especially around risk assets. And a lot of tech companies, a lot of cryptos have been completely wiped out of their gains year to date. And people are talking about whether or not this is the end of the correction or just the beginning. How do you see it?
Well, I guess the answer is it depends, right? I've been actually talking about this a lot on Twitter. And if you follow me, or X, if you follow me, you can kind of see this, is the liquidity backdrop, which, a thing that I look at very closely is just understanding what global dollar liquidity is doing, right? Dollar liquidity is ultimately the most important measure, I think, because there is, not only is it the dominant currency for most trade, but there are enormous amounts of dollar-denominated debt outside the U.S. So there is a constant need for dollars, and this is actually, we'll touch on this as a fourth turning theme as well. But just generally speaking, I like to track very closely what happens with liquidity, because it tends to tell you a lot about the risk environment, right? So, you had Keith on the show, so you probably heard him, or if you've consumed some of the research, he talks about the machine, right? That the market, the machine is likes flows, and it's like it needs liquidity to feed that. And so when liquidity is tighter, you got to sell something to make something else go up, right? When liquidity is expanding, everything can go up. Maybe now it's a relative game, like some things go up a lot more and than others, but generally speaking, it becomes a game where sort of everything can win. But when liquidity is tighter, it becomes a lot more choppy, and you have an increase in volatility. And interestingly, what we saw is actually as the dollar started to increase, and as the treasury was, the treasury account at the Federal Reserve ahead of the shutdown, began to expand and went from about 300 billion in balance to about $1 trillion in balance, which is a huge drain on liquidity. And so as the Fed balance sheet has continued to come down in QT, and as some of the repos have sort of been used up, or the revolver's been used up, there's now it really tightened liquidity going into as we got into October, sort of late September, October. You could see the annualized rate of dollar liquidity really started to decline. And not surprisingly, what we saw is volatility spiking. And interestingly, you brought up crypto, and I had actually talked about this, that unfortunately for people investing, crypto just became the easiest source of liquidity, right? It's just sitting there. It can be easily sort of liquidated and in order to capture more liquidity. And so when I look at it as anytime you have global dollar liquidity running below nominal growth, you have to source it. Either the growth has to come down to meet the liquidity, or you've got to liquidate something in order to fund the activity. And so that's been the backdrop today. Now, as we sit here, the Treasury's balance at the Reserve, the Treasury's bank account will likely come back down. The normal balance is probably about 300 to 400 billion, and I would expect that will actually bring some liquidity back into the market over the coming months. Now we'll see. Now on top of that, the Fed is easing. On top of that, we're looking at probably the end of QT. And so as we look out into next year, especially if, as you're familiar with Keith's terminology around sort of the quads and like whether growth is accelerating or inflation is accelerating, decelerating, he sort of talked about a lot in the last couple of months about this idea of sort of a quad count of a 3-2-1, which is that we'll see inflation slowly decelerating and then actual growth beginning to accelerate as we get into the year, just on the year-over-year base effects. And add to that, the consumer is going to get a tax rebate in the first quarter. So there could be some reasons why things could actually, at the margin, be better and liquidity could be better, but you want to be cautiously aware of that as we look out over the next few months. So as I say, going back to where I started. I keep watching the liquidity environment because if liquidity begins to expand, then it will be sort of an all clear. And I would expect that you'll get volatility coming back in, perhaps, and you'll see the market begin to move again. But we shall see.
Let's take a look at this chart here. So global M2 money supply, white line with the S&P 500 3-month leg. So it's clearly showing that the global M2 money supply is a leading indicator for price performance in the stock market. Is this a coincidence or is this causation?
Yeah, I mean, I think it's somewhat causation, right? Like it's available dollars to buy
assets. Can you explain that? What is the transmission mechanism between higher money supply and into the stock market?
Yeah, I mean, the more money supply is available, the more things can be purchased, right? So, I mean, the more money supply around is actually increasing the amount of available liquidity to drive asset prices up. And so, and as I say, I look at not only look at global money supply, but I want to convert it back. Oh, well, as you have it here, convert it back to in dollars. And so what I look at is not necessarily even the year over year, because if you looked at year over year in this right now, it actually looks quite good. It's probably up about 8% year over year. Yeah. That's not what matters the most. What matters is what's happening at the margin. And when you look forward, on a 6-month annualized basis, that's now down to sort of probably under 5%. As you get out to the 3-month annualized, it's under 2%. And anytime you're under nominal GDP, which is across the major economies, like 4.5%, it tends to bring in some pressure to the markets.
Can you just make a thesis then, long-term investment thesis, that global liquidity conditions will not dry up? There's no reason for the money supply to contract. Like you said, the end of QT is coming up in a couple of weeks. The Federal Reserve is going to be even more dovish, potentially after Jerome Powell leaves. And so the long-term positioning should just be long, because if it's correlated to, or at least go ahead. Great point. And that's a good lead into some of the fourth turning themes. I mean, you've had Neil on the show, so you know how Neil thinks about this, right? And I'll probably paraphrase him poorly, but the point being that, his view is that when you look at deficits, right, those will have to be monetized. How are you going to do that? Like I think when he was even on your show, probably talked about this, that the history would say that they're going to try to inflate away some of this, right? So to get that nominal growth, you're going to have to inflate away some of it. So as we look about one of the key themes, looking out, you want to focus on like inflation protection is going to be something that's going to be chronically sort of needed. And one of the key things that we're doing in the fund is sort of thinking about, how to protect your assets in that type of environment. So as we look over the next 10 years, we probably see pockets of higher volatility. We see increasingly sort of chronic needs for the Fed to expand its balance sheet. And there will be, not to mention a reindustrialization policy that that we are currently sort of on, will have to be monetized as well. So this is all something that leads to the potential for chronic inflation pressures. I mean, even to your point, like you brought up that we are looking at the Federal Reserve cutting rates. Well, inflation hasn't reached 2% yet. The 2% was always the target that they talked about. We're kind of around 3%, and we're talking about cutting rates. All right. So already we've sort of let that bar of like what we should have, where inflation it should be, has already begun to move, right? They've now moved the bar from 2% to 3%, which is telling you now structurally we're looking at a higher potential inflation over time. Gold is one of the best assets of this year, and you already know why people hold gold. Well, it's because it's real money. But what if your gold could do more than just sit in a vault? That's where today's sponsor, Monetary Metals, comes in. They offer a way for you to earn yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your bullion can now work for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar does. Thousands of clients already earn monthly interest in gold and silver through monetary metals, so don't just hold it, put it to work. Go to monetary-metals.com/Lin, link down below, or scan the QR code here to learn more and get started. Let's take a look at this chart that you tweeted though. So here you have which way liquidity. This is a retweet of Keith McCullough's post here. Credit spreads. This recent move higher shouldn't be ignored. Okay, tell us why.
Yeah, well, because ultimately we'll have a credit event. If you have credit spreads moving wider, then that's a function of, it obviously makes borrowing more difficult, right?
It is still much lower than the historical average though, isn't it?
Oh, totally. I mean, high yield at this point is very close to the lows for spreads, not the highs. And as I say, if liquidity begins to expand, and if the treasury account comes back into the market, I would expect these yields to stay tight for a while. Now, how much lower they can go, I guess we'll see. I mean, if you're already at sort of 200, 80 over, historically they haven't gone much lower than that, and so we'd expect to see, we'll see where they continue to be over time.
Looking ahead, then, so assuming liquidity doesn't falter, we don't have a major liquidity event in the next 12 months. Then the question is, how do we allocate capital? Because presumably all markets get lifted, but some more than others. How do you define this problem?
So, well, it becomes a relative game, right? So the capital goer, it's treated as best. So I think, So I think when we look at, I mean, you certainly expect some areas of equities to be strong, I would imagine. Equities do have a history of being somewhat of an inflation hedge. Can depend on the different sectors as to how they do. Certainly, combined with the potential for a real AI-driven reindustrialization policy, all of the build out of the data centers that are being planned over the coming years are going to be significant for activity, and on top of that, the power demand from that, and we're going to have to follow up building power demand behind that. So all of this is areas where you could see earnings revisions, and positive earnings revisions are a driver of earnings prices when there's liquidity to support the price going higher. Full stop.
So let's paint a picture for further out. Going back to my earlier question in the beginning, what does the next 10 years look like? How will the world change fundamentally in the next 10 years? And then we'll talk about investment implications. Yeah,
so I mean, this is the one you need Neil back on for, right? he'll talk a lot about this if you wind him up and let him go. I mean, he's been talking about this for decades, that as to what's coming, and some of it's somewhat obvious from an observational standpoint, like demographics. Right. What's less obvious, and where Neil's insights are always really compelling, is what that means for the outlook, and like how that might change society, how it might change our behaviors, how it might change what we value, how it might change a lot of different things. But faced with certainly the potential for chronic deficits, given that there's off-balance sheet spending in the forms of healthcare liabilities, social security liabilities that are coming onto balance sheet effectively for the federal government in the foreseeable future. We are sort of faced with potential for chronic deficits, never mind also the themes of potentially rearmament in a world that's become more dangerous than we've certainly been used to over the last 20 years or 30 years. And then as we go, the aging of the populace in the U.S. is causing some of that as Social Security demands become higher, healthcare demands become higher. So all of this is tied together, but it will create a backdrop where ultimately it does lead to, one, I think, more sort of chronic potential inflationary pressure, but also just a higher volatility. I mean, just all the things that we have become used to. Like, here's a way I sort of explain this, David. Like, think about, if you've been around doing this a long time now, and you talk to a lot of investors, and you look at lots of investment charts and things. When people look at sort of a long-term chart on something, right, they talk in terms of like, well, stock has never been cheaper in the last 10 years, last 20 years, right? You could throw up a chart of 30 or 40 years and people are like, whoa, that's really long. And yet, like, think about that. It's like half the lifetime of one person. right? Like, I mean, all of our modern financial system is based on sort of these like extrapolating things that have happened over, effectively 100 years, right? I mean, it's like deep research to go back and do work on valuations pre 1900, right? It's just the data is just very hard to come by. And so most of our modern heuristics around this are all built in a very short period of time, right? And they're all generally from the this last turning, right? This sort of like post World War II to now, is basically most of the modern, financial history, and certainly expands even longer than the period that most people have even been actively managing money in this environment, right? One of the most fascinating things of watching inflation pick up post in COVID was the first time that we'd seen inflation at that level since literally the 1970s, and there were almost nobody left working in the financial markets that had ever seen it, right? So like this was totally novel to most people's lived experience. Last time there was inflation like that, I was an infant. So I just think it's fascinating to see
Sure.
how how could be very different. The next 20 years could look very different than the last
So let's lay
40.
out the agenda for the rest of the conversation. You've got the three pillars:
Yeah.
protectionism, reinflation, industrial policy, rearmament. Well, let's talk about rearmament first, and then I want to talk about your work at the Biophysics Economics Institute, Biophysical
Biophysical
Economics
Economics
Institute.
Institute. Yep.
Very interesting work you're doing there that ties into the themes of energy as well, and we'll close on there. So let's talk about rearmament. Just today, on the 25th of November, the Trump administration has reported that Ukrainian delegation has agreed with the U.S. on terms of a potential peace deal. So we'll see how this plays out. U.S. Army Secretary Dan Driscoll held a secret talk on Monday with the Russian delegation in Abu Dhabi, and now it's been disclosed what the talk was about. Army generals and high-ranking officials are being sent to Ukraine as we speak to further consolidate talks with Zelensky. I was thinking about this morning, and some questions came to me privately. How does this change the investment landscape if the war in the Ukraine de-escalate? What do you think?
Yeah. I mean, I think it doesn't, quite frankly. I think it's going to be perceived to, right? And certainly you saw that with some of this news of the deal out, right? I think most of the defense stocks sold off on that day. No, small irony that like Rheinmetall, the German arms company, was out actually saying their sales are going to 5x by 2030, right? So this spending is happening regardless of what happens here. Like, so the Europe's increase in defense spending, that horse has left the barn. Like that's going to happen. You've seen some of the saber rattling between Japan and China recently. That's again, we're seeing this crank up, right? Like this stuff is all happening. And even if there's a Ukraine deal, do we really think that that is like there isn't going to be a continued sort of military buildup within Ukraine to defend a potential another attack down the road? There's still the rebuild of our own arms, not to mention the modernization of our own military around building out drones and other things that are going to be needed for the future ways in which we fight wars. So I think that the secular trend of the spend increasing here doesn't really change just based on the fact that this deal has happened. Again, I think that perception can change in the short run, but then I think we just have to wait and see fundamentals play out. And as the funding continues to go up, and these companies revise revenue and earnings higher, then this is what happened. The stocks usually follow.
No impact on commodities, oil?
I mean, certainly oil could potentially have an impact, but I would argue that most of it hasn't really restricted much coming to market, right? I mean, Russian oil has found its way into the market one way or the other. Iranian oil, when they were like coming to the market, like this stuff was getting into market. It's just a question of has to be sold at a discount through, through different trading houses that are willing to accommodate it, but it ends up coming to market. So there's no like supply that comes on that wasn't there. In fact, arguably, you could actually even make an argument that if it leads to improved economic, conditions, it would actually be bullish for demand, right? So when I think about, I mean, in the near term, certainly there's a lot of talk about oversupply and oil and that type of thing. But I think we all know that anyone who observed the onshore shale story in the U.S. knows that the break even for oil price production has gone up quite a bit for the last few years. I mean, I looked at this years ago that you could see that the long-term inflation adjusted price of oil was about $20 over 100 years, and then basically ramped to 40 and now to close to almost 60, where activity falls off very quickly under 60. Rig count goes down. Most of these companies will not expand projects if it falls much below sort of 60 to 50 to $60.
So who are we rearming against in the next 10 years is the larger geopolitical question. If, let's say,
Yeah.
things de-escalate in the Eastern European front, and who knows what's happening in the Middle East, who's the bigger enemy right now or into the
Yeah.
future?
I mean, certainly, obviously, I'm not surprisingly will pull from the headlines, right? The Cold War that is ongoing is between not only Russia, the U.S., Russia, and Europe, but most importantly, China and the U.S., right? And the flashpoint of Taiwan is obviously a very key one. But we're seeing, I think that's where you see for the most of this activity, sort of this multipolar world where you do have big zones of influence across both, Europe, U.S., and Asia.
Rearmament in which sense? The cyber sense or actual physical hardware? Because that impacts which sectors move.
That's a great point. Actually, it's one of the things we're looking at both within the fourth turning fund. We've kind of focused both on not only, I think we'd say, overall a growth in defense spending, within that focusing on the things that will have more of the future way in which we fight wars, right? Which drones are a good example of that. But then also to your point, like cyber. And I think, if you look again, if you're following the news closely, which I know you do, there's been no shortage of, news stories more just recently around the increase in hacking activity by nation state actors, right? So this is happening now, right? We're already in it. They're already seeing sort of cyber warfare going on, and so increasingly, I think cybersecurity is an ongoing theme that we'll be exposed to, at least to some degree, inside the strategy.
All right, let's move on to some monetary issues now. So we talked about reinflation briefly, but to what extent will inflation reappear? Are we talking about 3-4%? Are we talking about double digits like the Volcker area? What does the future look like?
Yeah, that's a good point, because I think one of the things that got missed, like if you take it back to 2008, 2009, and the expansion of the Fed's balance sheet in the wake of the financial crisis, you actually didn't see, like at the time, there were a lot of people calling for an inflation spike, right? Because the Fed was expanding the balance sheet so aggressively and introducing QE to offset the potential effects of the financial crisis, that there were many pundits calling for inflation. And it never really showed up, right? So there's a couple reasons why. I mean, one of them is that obviously, Chinese imports to the U.S. continued to be a deflationary impact on the economy, but also I think there was no real transmission mechanism. So the answer to the consumption, like to consumer price inflation. So what you had actually happening was that you saw, I would argue we did see inflation to some degree. We saw asset price inflation, right? We've had, huge returns across the market over that period, over the last, call it now what, 15, 17 years, 16 years. And that's, in part, that's been a function of the expansion of the Fed's balance sheet, right? So where I think you saw post-COVID was the first time you saw a real transmission mechanism, right? So like you actually saw the money not only being sort of printed, but then literally sent in checks to people to spend, right? And if they get money, they're going to spend it. And so certainly against the backdrop of supply chain constraints that were happening, due to COVID and that you saw inflation take off pretty aggressively. So it'll be a little bit different, I think, this time, right? I think you have, certainly the potential for sort of energy cost-driven inflation, but it's less likely to spike the way we saw in, say, like the Volcker era, like to your point, the Volcker era type inflation, but more of a gradual dial turning, right? That because it takes a while to bring on new utility supply. It takes a while to build this out, right? It takes so as you're and certainly new mines. I mean, any of this stuff takes a while to bring on more supply, and so those are long wave things. And I think if you begin to see, depending on how aggressively the Fed is expanding the balance sheet, but then also how aggressively we try to finance this and push forward many of the either reshoring, the rearmament theme, but obviously the big elephant in the room, AI and data center spending. As if we're going to spend that kind of money over the next few years and move that kind of material, it could certainly have an energy and materials cost inflation, and that'll bubble through to some degree in price increases. So,
The biggest argument against long-term inflation, where the reemergence of long-term inflation actually is AI. Some people claim that AI is inherently deflationary. Well, all technological progress is deflationary to some extent. What's AI going to do to our overall costs?
yeah, I mean, do we
Supply,
know?
massive supply output gap. I mean,
Yeah.
yeah, that's one argument against long-term inflation. Have you thought about
Right. So
this?
I have. Well, I've tried to unpack it. I don't know that I have a perfect answer for
Sure.
it. I mean, right now it's an inflationary force, I would argue, right? It's because it is actually it's subsidizing demand by selling at a loss. All of these companies are effectively losing money in their AI endeavors. Nobody's turning a profit in AI right now. Now, obviously, that may change down the road as all of this becomes as they deploy more services and agentic AI and things that like they can actually monetize and finally see the value. And ultimately, it has to, right? Because these companies are not only spending their cash off the balance sheet, they're also beginning to borrow money to do it, right? So they're now, I mean, Meta alone has gone from a net cash company to a net debt company, right? Over just the last year. And so these companies are, which means they won't be buying back stock, like these things that they used to do, like that's probably now going to not happen because they're continuing to add debt to these balance sheets to finance this build out. So I think, again, like the more aggressively they try to do this, like it will, and we're subsidizing the end customer demand, selling effectively below cost. Well, then that's an inflationary force by itself because that demand is going to create more power price increase. Not to mention the material increase, cost increase across trying to build this much capacity.
What's going to happen to the bond market then? Have you taken a look at this? So long-term structural bull market kind of ending around 2021. If inflation reappears, can we see a long-term structural bear market for the bonds continue? This is the 10-year treasury yield.
Yeah, it's a good question, right? It'll sort of depend, I think, largely on what the components of this are. So if you look at, there's a great paper that I think the Bank of England did a couple of years ago. I hope I'm citing that correctly. That was looking at sort of the long-term average, risk-free rate over like 300 years or something. I thought, or maybe it was 400 years, right? And they linked this by using not only sort of originally like in the lira and then in the pound and then in the US and like linking them across like what was the predominant risk-free rate or underlying instrument that was marked the risk-free rate for those periods. And what it comes back to is that it's roughly about kind of like call it 4 to 5% has been the average for literally hundreds of years. And it's probably not that mysterious as to why. I mean, ultimately, it's growth plus inflation, right? Get you to that yield. And so the question is like, looking at the demographics, we'd argue, I would say growth, the real component of growth will probably slow. If you have productivity increases, maybe the real component of growth goes up. Is inflation the same as it's been, roughly 2% or 1.5 to 2%, or is it slightly higher? Does it go up to 3? Let's just stack these things up, and it tells you like, well, this could put the bond yield at something closer to like 4.5, 5.5% as we move forward. But I mean, that's not happening today, right? That's at 4% today. As like some of the slight flight to safety around in this liquidity environment has actually driven the yields back to closer to 4.
Demographics, you brought up several times. That's probably one of the biggest changes that our society will face is an aging demographic, aging population, and lower growth in the population itself as the fertility rate for most developed countries falls below 2. Certainly you've tracked this. Neil talked about this. How does this change finance?
Yeah. I mean, not only that, like, right. So not only do we see, many countries where you're well below replacement rate, right? And, the US is somewhat better, but still pretty low. And especially without immigration, we're quite low. most of the countries around the developed world are below replacement rate today. I'd argue even Neil and I have gone back and forth on this. If you look at the UN projections for population growth, they've typically every time they revise their predictions down, not up, and that's mostly because these fertility rates around the world have actually come down quite a bit faster than even originally anticipated in most cases. And some of the policies that were meant to drive improvement, like say, I think when China got rid of their one-child policy and tried to incent growth, South Korea's tried to incent more growth, hasn't worked. Like you haven't seen a bounce. I think there's a lot of reasons why you could probably argue why that's the case, but it just becomes very difficult to actually see how that demographics are a tanker, right? Like turning that takes a long time to actually see that really make a bit long wave improvement. And for now, it's still moving in the same direction, which is slower. And that's just fewer people buying stuff, right? So I mean, that's fewer people to consume for growth, right? Like to consume, which fewer consumers means less growth, right? Unless they're consuming that much more per capita.
A few trends I see emerging from this. One, maybe healthcare stocks long-term bullish. I'll let you comment on that. Number two, depending on how the government finance more Social Security because of the aging population, potentially higher taxes. And fill in the blanks here. What else am I missing?
Yeah, I mean so those you hit the most important ones, I think, which is that you're seeing like AI. The jury's out on whether AI will like vastly increase productivity or not. I don't know. I mean, I think so. I think it should have some positive impact, I would hope. And I think, but if you're looking at the flip side of that is that an aging population, right, is got a higher sort of dependency ratio where you have more and more people who are over the age of 65 than there are people under the age of 65, or people over the age of 70 and 80 than there are people. And as that balance continues to shift, like that burden of paying for both like healthcare, Social Security, these things kind of fall on the group that the younger cohort. And so how will you do that? Well, I assume, in part that has to be either through raising taxes or it has to be through monetizing the debt, right? I mean, there's no real, or cutting the benefits. Like there's not really another way to slice it, right? You either have to something has to give across these. And so I think, as Neil has talked about, I think maybe even on when he was discussing with you, like, I think he brought up this concept of like, because certainly something he's talked about with me, like that, we could see almost like a change in families. Like there may be more multi-generational family happening again because like taking care of elderly parents, like having things in communities, because the cost of the way we've done this is very, very high. Right. And so continuing to do that in the same way will be very difficult. And as, again, as the aging, if the average age is increasing, that's itself is kind of a drain on productivity. And as like obviously personally, we all want healthcare for our elderly parents, but as a society, that's a sort of a productivity drag, right? Because spending on like the least productive people in the society is not exactly like it's like a high productivity use of the. Yeah, obviously from a personal perspective, it's fantastic in the sense that you want to have your parents around or your family members around for longer. But from an economic standpoint, it's ultimately kind of a drag on productivity.
What's the energy and or commodities play for the long-term build out of data centers, hyperscalers, and AI to infiltrate every corner of society?
Yeah, it's a good question. I mean, it's everything, right? So one of the authors that was really influential to me is Václav Smil. If you've ever read any of his books or you're heard his name before, he's written a ton of books on energy transition, energy in the world. I would recommend any and all of them. But I think one of the things he talks about, one of his books is that we've never like stopped using an energy source, right? Like when we discover an energy source, like we burn more firewood today than we did like 100 years ago. It's just decreased as a percentage of the energy mix, right? But like we don't stop using anything. And it's actually one of the biggest issues with, I think when I, look back at kind of how we were approaching sustainability when people were talking even just 5 years ago, how we were going to be sort of off of fossil fuels within, 5, 6, 7, 8 years. And you're like, it's just not realistic. Is like these are high density, high energy return on energy invested fuels. They are are the reason we have like all of our sort of modern lifestyle. That replacement is not as easy to do as I think many would have people believe. And what we're seeing now is if you bring in AI, which is enormous power use, then we've seen not only this resurgence in looking at nuclear power, but also even natural gas, which will be needed to balance this. And so I think when you talk about the two things that I would say probably have, I think, a pretty strong good outlook is nuclear energy will continue to ramp, and natural gas will continue to utilization will go higher. And certainly we're seeing all the signs there. I mean, like if you look at the gas turbine companies are seeing massive orders into their backlogs. We're seeing, we're bringing 3 Mile Island back online, right? I mean, I wrote this piece. So back at BNY Mellon, we did a frontier themes piece about 6, 7 years ago. And my contribution to that future frontier themes idea was the return of nuclear renaissance. And my argument was that if they were really serious about doing a zero carbon grid, then there's absolutely no way to shut down your nuclear. In fact, you have to build more because a nuclear is the most reliable, lowest carbon intensity, highest energy density source we have. So this idea that, you saw what happened in Europe. Germany shut down many of its nukes, became incredibly dependent on Russian gas, and then has now had a huge deindustrialization problem where the costs of running their economy have increased dramatically because of the cost of energy.
Who's building out these nuclear facilities? You're right, but they're also very high capex. Are we going to see them coming out from the state or private utilities or the tech companies? Microsoft recently restarted an old nuclear reactor, for example.
Yes, and yes. So I think you're spot on, right? Like, so the government's going to be helping to finance some of this. They're already out talking about this in the news. I mean, that part of the policies of the Trump administration are actually quite supportive, as was the Biden administration for nuclear. I mean, they were the first ones to actually bring this back as part of the what was it called? It was the inflation beating bill or something. I remember what they called it.
Inflation Reduction Act.
Inflation Reduction Act. Thank you. I was like, as part of this, I was like the most kind of absurdly named bill considering the contents of it. But that was, as part of that legislative agenda, they had brought back credits, improved credits for nuclear energy, and you began to sow the seeds of what's coming now. And certainly the Trump Department of Energy has been actively looking at not only traditional nuclear, to your point, but also new possibilities inside of nuclear, which like small modular reactors, like companies like I think Oklo and NuScale and any number of other ones. And the interesting skunk works thing that's happening in the background too is many private companies that are working on fusion. Many of which I've talked to over the years. And that, that's whether that will end up working or not. I mean, those projects are ongoing, and we'll know within a few years whether some of them are potentially have a pathway to being viable sources of energy. But I'm a bit strong believer that the future is nuclear, both fission and fusion. It is just it's the most reliable base power that we can at the highest energy density, highest reliability, lowest emissions power that we have.
Okay, well, let's close off on some out-of-the-box ideas that you've accumulated through working with the Biophysical Economics Institute. You've brought some interesting concepts to me offline, and it's not something that we as investors typically think about. Tell us about what you guys are looking at right now. Yeah,
so really the idea behind the Biophysical Economics Institute is just really focus on, what I think is really a misunderstood component of like the economic sort of production function, right? If like most people have been to business school or taken an undergrad economics class can cite, capital and labor as the inputs to the economy, and it treats energy as if it's a completely substitutable good. When in fact, to quote economist Steve Keen, capital without energy is a sculpture, and labor without energy is a corpse, right? Like none of this works without energy. And I think before we got on, I mentioned to you the sort of thought experiment of like if the energy companies disappeared tomorrow, it would be riots in the streets, right? Like no one could get to work, no one could do anything, lights would go on, like the entire economy would crater very quickly, which is surprising considering it's like 3% of the or less of the of most indices. And yet, by comparison, there are companies that have much more market cap than the entire sector that could vaporize overnight. You'd never notice. You'd be like, yeah, all right, life goes on. Like, you okay? Like, I mean, it's like I was doing this thought experiment even on like the something with Mag 7, right? It's like if Amazon disappeared, I'd be like severely disrupted in my daily life, right? Like if Netflix disappeared, I'd be kind of like annoyed, but I'd get over it. And if Mag, I mean, this probably speaks to my consumption of social media, but Meta disappeared. I was like, I don't even know if I noticed. Like, it would take me a few days. Maybe my daughter would care. I don't, but it would take me a little while to even notice. So it's just an interesting thing, and how we treat some of these crucial inputs to our economy are not accurately assessed, and it's led to some wrong thinking about. I think for example, like the one I gave, right? It gave that we could shut down nuclear power and somehow also get to this carbon-free grid, and it was all going to be done on the back of intermittent renewables, which that was somehow going to drive costs lower for energy, and all of that became, I would argue, just bunk. Like and I could have told you that, like based on the work we did around energy return on energy invested for many of the renewables, especially when you adjust for intermittency. And so I think you have to look at the sort of the total cost of the system for many of these things.
This is an interesting topic, and as you were talking, I was thinking about this. So the idea of multiplying force. So you have here, let's say, 1 unit of gasoline or 1 unit of raw material input. And then in the olden days before the internet, you had some manufacturing company or production company using that 1 unit to generate to generate X unit of input versus Y unit of output. I believe in the tech age that Y unit of output is significantly higher than before. So therefore, it's a lot more efficient how the tech companies are able to utilize output using 1 unit of input. And so just think about Meta. Let's take Meta, for example. Yeah. You have Meta consuming relatively small amount of electricity and energy compared to the amount of GDP that they and all the companies around their ecosystem are generating using that technology. It's just incredible how tech.
Yeah, no, that's a great point. I mean, I would say, yeah, totally. And I did some work around this a couple of years ago where we looked at kind of trying to look at the underlying energy return on energy invested sort of by so I won't get into all the way with the conversions we were doing, but we're looking at sort of like the energy intensity of the economy, converting that back to the sort of the energy component of the dollar, and then looking at the revenue to the energy input cost to look at different sectors to understand their relative like sort of efficiency at converting energy to sort of energy GDP. And software was a very high ROI area, as you can imagine.
Okay, I want to finish off on digital assets. How do digital assets fit into the fourth turning narrative in the next 10 years? Blockchain, tokenization, stable coins. Does that have a place in this future?
Yeah, I mean, certainly. I mean, I think it's something we track. And as if you're familiar with Hedgeye's work, right, and one of the things we are integrating into the strategy quite closely is not only the top-down macro work that's done by Hedgeye's, the rolling outlook of the quad outlook for growth and inflation, but also the risk management that we use to sort of signal when it might be worth owning something, when it's not. Hedgeye's been very vocally bearish on crypto recently. So it's proven itself to be a very high volatility asset. It's not clear to me whether that's a feature or a bug. Over time, perhaps because that volatility comes down. It has not so far, and it has led to, these crypto assets, Bitcoin in general, but all of them in general being highly correlated to things like the NASDAQ, not necessarily something like gold, where like their correlation is kind of less obvious, where to me that always seems like it should be. If they're really just stores of value and have a low supply growth, then they should kind of track each other, at least to some degree, right? They should rhyme even if they don't totally overlap, and that has not been the case. So I think there's a lot of speculative activity that happens in these, which leads them to being more a highly volatile asset class. And highly volatile asset class is fine, but I think you want to manage that volatility carefully. And so we will probably intermittently look at these and could possibly have them involved in the portfolio over time.
Thanks very much.
David,
I
this was awesome.
appreciate your
Thank you so
time.
much. Yeah, I
Yeah,
really appreciate
RVK,
it.
where can we learn about you? Where can we follow you and Hedgeye as
Yeah, I
well?
mean, you could check out, obviously, you can check out the Hedgeye AM website. There's certainly some information about the funds and for us up there. If you want to, if anyone wants to follow me on X, you can find me at RP Kent. Very easy to remember. Yeah, I think, and obviously, and I pop up if you're a subscriber to Hedgeye Research or you follow it into sometimes. I've been popping up sometimes on the call or on different parts of that to do some of the media as well.
All right, excellent. Thank you very much for your time today, and we'll follow you in the links down below. So check that out. See you next time, Patrick. Good to
All
see
right,
you.
excellent. Thanks, David. Appreciate it.
Thank you for watching. Don't forget to like, subscribe.